volatility. It's hard to make estimates about what you're going to do because measured moves may be a little longer than normal, or you may not have any angular differentiation. So often it's a hard place to find where to start. Here's an example of on a 60-minute E-mini that's clearly in a downtrend. And if we were halfway into this trend, let's say over in here, we might want to start to look at this chart and see what kind of harmonics and rhythms we can find out about it. The first thing you always want to do is start with the initial impulse wave. And clearly this is from the high to the first low, and at that point it started a little tiny higher bottoms, higher tops. So this was the first rally. What I usually do after that, though, is I then take my measured move and turn it into a circular arc. That will adjust it to the theoretical maximum it could have gone. Often this would give you theoretical results that are better when you're playing with the numbers and support and resistance than just using the actual swing. So from that adjusted basis down here, I will use this as if this was my first swing level, and then I'll put my natural ratios on from this level. And then when we see, if we use the adjusted basis here, we see it fits our chart pretty good. And many of these swings will come out a lot better, almost to the exact numbers, so we can see what we're dealing with in terms of support and resistance. And again, all these numbers are spawned from the initial first little leg down. Then we can add to our information here by putting some angles on. I'll box in my very first little swing, and I'll make that a 4x1 angle. And then here's the 2x1 angle, and here's the 1x1 angle, which is basically your definition of the bull or bear trend. And we can see that the market will have a tendency to bounce around the angles. It will overshoot. If this one was complete, we can see that this angle would have come down into this area, would bounce off that angle and bounce up here. And I say over here, try and enter trades where the angles are broken at the same level as the natural ratio lines. So this one has been attempting to base right on a perfect natural ratio line, and it's gotten above the angle. So you'd certainly be out of a short here expecting a rally, and you might even want to trade long for, since this is a 60-minute chart, maybe for an hour or three with a stop and see what happens as they probe the next level and maybe even the angle. And when they go up and they start to fail again, they are above the 1x1 in here, and there's a chance the trend is turning up. But it's certain that once they break back under the angle and under this level, you have to return short here, because there's no telling how far it will go down, and often they do plunge down and catch up with the angle again. Now down in this level, they did get all the way down to either this level, or they could have plunged a little bit lower to the next level down. When you're nearing what you think to be a final low, and we're not certain yet because we're right on an angle, but it could plunge down to this next level down here, I try and make some sense out of the patterns. Now, although there is a 1, 2, 3, 4, 5 wave down here, and maybe, or you could even count it as a ABC giant wave, but I like to look at the symmetry. And the first big leg down, avoiding this little, this was the fat finger crash day, but assuming this was a more legitimate bottom, there'd be one leg here, and making a parallel to that, we find out that in this area, at this measured move, it would be the equivalent here. Now, if we did have this little plunge down, that would give us some extra room to plunge down and touch the angle. But we are now at a point where we could be looking for a rally. And even though this might still be very bearish, it's oversold enough to support a rally that could go all the way back up to this trend line near 1100. And from 1140 here, we're talking about 60 S&P points. Or we could also see a case where this is a giant 1, 2, 3 waves, and the fourth wave would come up here to be followed by a very giant 5 wave that would go all the way down again. But regardless of whether it's a final low with a little two-step here or it's a fourth wave rally, there's going to be a rally, coming out of something like this. So often after you get your little tiny cycles in, you want to look at the bigger ones and make the second largest measured move component that you can find. Also, it's good to keep track of the intraday patterns that you normally run into. Now, normally, all the patterns are based on time, fundamental units of the number of hours or minutes that your particular market is open. If you're in a foreign market, they have different trading hours. But in the United States, we open at 9:30 a.m. and we go to 4 p.m. for the cash market. There's a lot of Globex 24-hour trading, but most of our activity is from 9:30 to 4. So this is 390 minutes. And also, I might add, when you're keeping charts, you like to keep charts that are a fundamental unit of the trading day. So the hourly chart used to be perfect, but no longer, because now we have, in 390 minutes, we have 6½ hours in the day. So the only real fundamental unit that goes into that is the half-hour chart. And you could also have 15-minute charts. But the half-hour chart is superior these days to the hourly chart. But anyway, the 390-minute now is set up into divisions of, eighths usually. 1/8 of 390 is 48¾ minutes. And the other strong harmonic is 10%. And 10% of 390 minutes is 39 minutes. So we find that from a 9:30 opening, if we add 1/8 of the trading day, 48¾ that turns out to be about 10:19 a.m. It's actually 10:18¾ minutes. So we see a big turn every day at the 1/8 marker into the day. We also get a turn at the 10% marker, which is 39 minutes after the opening. And this is usually 9 minutes after 10 in the morning. Now remember, these counts are natural periods from the opening. A lot of times the opening is not significant. It doesn't gap up or down. It's a quiet opening. Maybe the big spike in the morning might occur at 5 minutes to 10 a.m. or 9:55. If it does at that point, you would want to move forward from that 9:55 big spike, your 1/8 in your quarters and your 10%. And that's where you would find your cyclic turns. So we keep track of these units. Here's a couple graphs of them. The 10% ones are these little arrows, and the 1/8 or 48¾ minutes are these wedge type things. And we can see that they fall fairly close to where the big turns in the market are, at least tradable turns if you're trading, this is a 1-minute Dow Jones futures. So if you note on a 1-minute chart, they're only off by a minute or so from fairly significant swings. When we get over here and I said 50% of trading day, this is the 40%. And from 40 to 50 is where the turn comes in. Here's the actual 50%, and here's the 50% on each of the 1/8 and the 1/10 cycles. And we can see right after that turning point was a most dramatic move of the whole day. And then the other little turns were in here. So this is based on these cycles coming from the first major high earmarked over here. And here's another look at the harmonics in the same way, and they're labeled here 20%, 30%, 3/8. You can also, with the 10% moves labeled this way, you can look at some other oddball numbers. Maybe the Fibonacci one, 61.8, would fall right in here. And or 72% might be in here. 75% is 3/4. And we can see that most of the harmonic turns during the day do come on these natural breakpoints of 10% and 1/8%. You can keep track of them too with a simple cycle finder tool. If this is a 1-minute chart, all you need to do is take any high or low and go over 39 bars, because that would be 39 1-minute intervals. And the other 48¾ let's round it up to 49, would be this distance. And here we can see that there's fairly good turns. They're off by a little bit here and there, but they at least give you warning of where potential turns for the trading day might be. What you can also do is, once you measure out the 39 minutes on your chart, maybe on this one I should have colored it red or blue compared to this other one, you now have the ability to take this bar and just slide it around. So if you wanted to put it on this top right here, you could use these slider bars from here and see what would be 1/8 of the day or 10% of the day from any of these highs or lows. So sometimes I'll keep these slider bars on my chart, and as we go to the next day, I just keep sliding these things over, and they always remind me of one of the fundamental units during the trading day. This one, you see, the 10% gave me a high to a high, and the 1/8 was basically a cycle that gave me a high to a low. So often you'll see those kind of correlations when you're doing intraday charts. There's some other principles to keep in mind about the day trading and the opening is that 80% of the time the extreme high or low for the entire day is made in the first eighth of the trading day. That's what I used to call the opening bulge rule, that everybody gets in. And usually there's buyers or sellers, whichever one is in predominance, will open the market down big or up big. And if there's follow through after that and they keep going, then that was the low of the day, if it opened up. If they open down big and reverse and go up, that could be a low of the day. If they open down, but then they go much further down, that would be the high of the day. The reason you get this extreme is that there are a lot of people in the know who have inside information on what's going on. If they know there's a big fund out there that's going to liquidate, the first thing they do is rush to the market on the open and try and get in front of them. You may not see evidence of this on the tape for a good hour, but the guys who know will be in there first with futures, and they'll get the options. And after a half hour or so of getting options and things under their belt, then they'll bring the big portfolio to market to either buy or to sell. And the rest of us will see what they have planned for us. So in terms of trading, knowing that it occurs by 10:19 every day in the first eighth, the rule of thumb is you look to see what has been the extreme range during the day at 10:19, and when they start to deviate from that, you go with that trend. If the low of the day has been made and they're going up after 10:19, so at 11 a.m. they're higher than they were at 10:19, it's going to be a bullish day and probably bullish all day long. Whereas if at 11 o'clock or 12 o'clock in the afternoon you're under where they were at 10:19, it's probably a bear market day and you want to short every rally all day long. And again, I say it's probably a bear market day because these people will be working in order surreptitiously, and you won't see it. They'll come in waves every half hour, every hour, and they'll do buying or selling. And it will leave footprints on the tape, but every couple of hours you'll see that it will be lower or higher than where it started off. Now, the 10% cycle often gives us a turn right after 10 a.m. And usually there's a straight line between the 10 after 10 turn and the 10:19 turn. This is often accentuated because of the delay in opening all the calendar spreads on the options. They start opening the options with the near strikes in the current month, and they go out all the way out a year or so in some of these options. And the big money needs to hedge their positions before they execute major arbitrage programs. If they have a $3 billion portfolio that they have to liquidate, they're going to spend that first half hour from 9:30 to 10 o'clock buying put options and shorting S&P futures. And they don't want you to see what they're doing, especially in the S&Ps. So what they'll do is they'll dive them down, and then they'll buy them back. And then they'll dive them down again, and they'll buy them back. And it's very easy to keep you guessing. If their objective is to be short 10,000 S&Ps in the first half hour, they'll sell 3,000 or 4,000 immediately down, several handles, and then they'll buy back 500 of those and jam the shorts and take it right up. And then they'll sell another 1,000, and then they'll buy 800 back, and then they'll sell 2,000, and they'll buy 600 back. And they can manipulate it such that in the first half hour, you don't really know what the trend is, and they'll end up being net short several thousand positions at a good average price. But after 10 o'clock, after the options open up, you will often see big blocks of options on the S&P futures and on the indexes, the Spider Index, and you'll see if they're buying puts or they're buying calls, and then the market will start to diverge after 10:20 and go with the program in the proper direction. So oftentimes it's not wise to trade, especially S&P futures, in that first half hour or so when they're just trying to set a good average price, and they will run the stops all the time knowing what the day traders are looking at, the angles, the support levels the day traders are looking at, and they have very big pockets. A lot of these big